I think if you ask investors or successful investors, the old adage in the market is it's not timing the market, but time in the market, which usually works. And having seen so many wealthy people who've become wealthy over a period of time in the stock market, you would have to agree, because the proof of the pudding, as they say, is in the eating. And the proof of wealthy people in the stock market is that they became wealthy by holding for a long period of time. So, you know, a lot of people scoff at this maxim saying, you know, that's for old fuddy-duddies. We know that timing is important and timing is everything in life. But, you know, timing is probably impossible to do. And I'll tell you why. And this is what actually a lot of successful investors tell us, is that it is impossible, even after you determine that this is a good business, to actually suss out accurately when the market will actually reward or unlock the gains in terms of price because of the strength of the business. It's always, you know, you see so many examples of a good stock where for 2 years the stock does nothing. It just remains in a range. And then in 4 months it doubles. That is the beauty of holding, which you cannot do with timing. It's just that you know at the core that the business is strong, but you cannot know for sure when the market will reward you or reward the stock for the strength in the business. It will happen randomly and in a lumpy fashion. And therefore, over a 3-year period, after that doubling in 4 months happens, you will still have made a compounded annual growth rate of 30% on the stock. But for 2 years, you would have made 0. In 4 months, you doubled it. And over a 3-year period, the returns turned out to be fine. So the key thing is to identify the good business and keep holding and not try to get in and out too often, because nobody can successfully do that. Entry and exit points are always important. The problem is that people conflate entry and exit points with timing the market. Timing is about saying, I know the highs and the lows. I can catch the highs and the lows. I know when to get in and when to get out. That is almost impossible to do consistently and over a period of time. However, entry and exit points also pertain to valuations. And I think that is the important distinction that one needs to make. That when you identify a good business, you also want to pay a lot of attention to what value you're paying to that business. This is not about timing. It's not about saying the stock is at 80, but the right entry point is 70 and the right exit point is 90. That is different. The key is to say at 80, the valuation of the business does not look attractive. And I think this notion or sense of valuation is quite important in being a successful investor. It is not the most important thing. I think the most important thing, if you are a long-term investor, as you should be, is the strength of the business. If you have picked the right business, but you've bought at the wrong valuation, chances are that you will still make money, and reasonably good money. You may not make as much money as if you had actually entered at the right time, but the cardinal sin is actually choosing the wrong business. But valuations are important, and therefore entry and exit points are important, because if you overpay when you enter, basically you will waste some time in the market till valuations or the earnings catch up with the high valuation that you paid for it. So you will lose a couple of years of time, which may frustrate you, but eventually you will still make money. But it's important to understand valuations, and the opposite is also true, that when valuations go completely out of whack in a good business, then you might be better off selling the stock also, and that is where the exit part comes in. So exit and entry are important functions for investors, but only in reference to valuations, not to be confused with trying to successfully time the market. I'm not a big believer in technicals, but I do recognize that technicals have their place in the lexicon of the market. It's not for everyone. Even investors look at charts. They get a broad sense of the trend in a stock, whether the trend is breaking down. They keep an eye on charts, but they don't go strictly by it. My sense is that it's important not to get confused between trading and investing. If you are an investor, which is what you should be, but the idea of looking at prices or monitoring prices is to basically get a sense of the regime in the market that you are in, because regimes are important. Even as for an investor, if you get the sense that the market's gone into a bear regime for 2 years or 3 years, then you need to tweak your approach, your weightage, and your asset allocation. The best returns do come from holding through cycles. There is no doubt about that. You have to ride a stock through a bull and a bear cycle, because if you don't do that, then you're trying to time the market, and chances are that you will go wrong. But having said that, it is sometimes you do get a sense when you're in a pronounced bull or a bear cycle on how to adjust your portfolio weightage and asset allocation in line with the broad regime that you find the market in. And only to that extent, I think one must have some orientation of the price movement of the stock one owns. Otherwise, it is best left alone, focus on choosing the business, holding it through many business cycles, keep a broad sense of the price action in the business that you own, but don't get overly concerned about it, because chances are that you will make mistakes in trying to time it perfectly.